Well, good morning and welcome to our breakfast discussion today on where is China's financial system heading, implications for Europe. My name is Guntram Wolf and it's a real pleasure to host this debate today. We have the privilege to have Bruegel Senior Fellow Alicia García-Herrero here, who's normally based in Hong Kong, but who works with us and does a lot of research for us. And she will present an upcoming paper of hers on China's financial system. So we will have roughly 20 minutes for that presentation. And following her presentation, we will have an expert panel discussing the key findings and the implications for Europe, which I think is going to be an open discussion, which will also allow you to inject your wisdom and ask questions. So perhaps let me introduce the panelists later, and let's start with a presentation by Alicia, so that we first get into some substance, and then we come to the panel. Thank you, Alicia.
Thank you very much. Can you hear me? Yes, that's good. Okay, so good morning, everybody. It's a real pleasure to be here. I feel a little bit scared, actually, to start by the fact that this was a 100-page working paper, and I thought I can't send this to Guntram, it's just too long. And we had, I don't know, like 200 graphs, and I was like, what is this? How come I came up with all of these details on China's banking sector over the years, which I started working on in 2000, so it's been a while. And the presentation, so I want to warn you, well, you see, it's basically telling me don't start with all of these graphs. It's just too detailed for the audience. But I hope I can show you some, if it's, so while this works, okay, I'll give you a little bit of context of what this is about. So, I mean, if you've been following on China's banking sector, the reason why there's so much information is that it's changed dramatically. So whatever, I mean, if you study any developed financial sector, you kind of start, and it evolves, but not at the speed China's financial sector has evolved. And on top of that, the economy itself is in transition, so the financial sector is in transition, and on top of that transition, you also have financial liberalisation and a catch-up in regulation, and of course, a number of restructuring processes out of excess credit and a little bit of cleanup that I will focus mostly about. So a lot of what I'm going to say is about the process of cleanup of a banking sector that has grown so rapidly that unavoidably, you need to clean it up, because every 10 years, it's basically double its size, if not more. So that's kind of the context of this presentation. So I move on to show you. Check. Is it off? Maybe. Okay. Okay. I'll try.
I switched it on.
Yeah. I can actually do this without any presentation, so it's okay.
So now.
Okay. So first, China's financial sector in this growth context, which totally changes the picture compared to other financial sectors. Then, again, the first wave of reform, I'm going to focus on the cleaning up. This is the early 2000s. Then I'm going to talk about the next wave of credit binge, which was since the global financial crisis to basically 2014, where it starts cleaning up again. So that's the fourth one, the next restructuring wave, which is, we are still into that. And then some consequences for Europe of this massive financial sector being cleaned up and growing and cleaned up and growing. What is it in for us? So I hope I can move this faster. Otherwise, yeah. So first one. Now, this is just to give you a sense when I say that China's growth is kind of pushing the financial sector to be increasingly large. This is what I have in mind. What I have in mind is an economy that in purchasing power parity today is as big as Europe. And even bigger than the US in purchasing power parity. You can argue not in dollar, never mind. But what matters is the upper part of the graph, which is how much China will contribute to global growth in the next 5 years, in the next 10 years, which is literally, I don't know, like 3 times even more Europe and double the US. So the growth is going to be there in the financial sector. We're not yet at status quo. So wait for more, actually, and a lot is already happening. So when we move to the financial sector, okay, sorry, this is going to be very painful if it moves only so slowly. Thank you. Yeah, here we go. So on top of that, I mean, many people have analyzed, and it's not very difficult to do that China's financial sector is not only big today because it ballooned, it's because it was big from the very beginning. So if you actually look at credit to GDP in China, even before the growth process, it was already very big. And I think one of the reasons is, of course, massive savings and a closed capital account. So all of the savings are, say, trapped in China, and they've been trapped at the level of nearly, before it was even 50% of GDP a year. So imagine how much you can do with such a high saving ratio. So basically, China's credit to GDP is already as high as Europe or Japan. So it's massive. This is just to give you a sense of that growth story in bank assets. So what you have here, if I can point, it does, but not very. So China's bank assets today are very close to those of Europe already, but coming in 2005 from something of the order of 5 trillion to 45 trillion. That's the growth story. And by the way, everything is growing. Market capitalization, bond market is not only credit, but the bulk, and that's why I'm going to focus on banks here, the bulk of the growth and even the bulk of the size of China's financial sector is in the banks' hands still today. So you basically have a comparison with the US, much bigger banking sector. Now, this graph is, I hope, is of interest to you. Now, if China's banking sector today is as big as that of Europe, and by the way, European bank assets are much bigger than those of the US, the question is, how big will China's banking sector will end up being? Because China is still in the financial deepening process, because its income per capita is 1/3 of that of Europe. So, the idea is, as they become richer, there will still be maybe not necessarily bank assets, maybe other types of capital markets, but the point is the financial sector will be even bigger. So just doing that extrapolation of how big, so you see that is the 5 trillion that I had before, bank assets, all the way to 42 trillion. Europe, so basically if you draw the line and you bring China in 2030 to an income per capita 2/3 of that of Europe, so in between, you will end up with 65 trillion in bank assets. So it will be by far, the largest banking sector in the world, by far. So that's what we're talking about. So what's the impact on the rest of the world of this massive banking sector? So we also know that all of this growth in bank assets didn't happen for free. What I mean to say is that, yes, in a way I could actually say that because China's income per capita is 1/3 of that of Europe, is if I may say, it's overbanked. I mean, bank assets are too big for that income per capita. Yeah. So something must have exactly due to the trap saving ratio. So what are the two implications that I'm showing you here? One is that, of course, massive credit to GDP gap. It's credit in excess. So when you have credit in excess, the very first thing that happens is that the return on assets is increasingly low. So China's return on assets today is 1/3 of what it used to be because of this massive credit growth. So this is the side effect of the growth story, that you just can't find enough projects to keep that return on assets at a decent level. Which brings me to the need for cleanup, an immediate link with the rest of the story. Now, the other very important thing that I can't underestimate the importance of this is that on top of everything I said, China's banking sector is still state-owned dominated. We may argue that, yes, the share, you see there, state-owned commercial banks, the violet line, plus policy banks, fully state-owned, maybe some, of course, they are, they have some float, but not enough to even make a difference in terms of who determines the policies of these banks, let alone policy banks. All of this is an arm of the central government and an arm of a policy instrument of the central government. So if you need more credit, there you go. You have window guidance, credit targets, and these banks will basically execute China's fiscal and monetary policy in a way. It's like an immediate multiplier. You just, you don't have to deal with the market, basically. You just order and it will be executed. And this is very important to understand why the credit pinch was so massive. Because there was no way for the bank to say, okay, for the banks to say, not really, this is too fast. I mean, instructions were given. And this is very, very important. You may say that the share of state-owned ownership is coming down, but I would argue, and Yue knows about this, having worked for a bank that was invested in one of the supposedly private banks, joint stock commercial banks, that they are not fully in private. Some are, but not all. So I would argue that a bunch of all of those other colors you see there are still, to the largest extent, state-owned, or at least receive government instructions. This helps China a lot. I'm not saying that this is necessarily a very bad thing in itself, because it facilitates the conduct of fiscal and monetary policy, but it has other consequences. Then you need to clean up. So you use them, you clean up. You use them, you clean up. This is kind of the finding, actually, of the paper, that the way this is run requires restructuring, because you're using the banks for other purposes, basically growth purposes, development purposes, monetary and fiscal policy purposes. So I'm going to start very quickly with the second part, very, very quickly. For details, please refer to the paper. Hopefully it'll be published soon, because this is too detailed for the audience. I'm very aware of this. I just want to give it, in a nutshell, the idea of the first restructuring phase. So why did we have the first, and when? It was the beginning of the 2000s, after two rounds reform, restructuring of the state-owned enterprises in China. You can imagine. Anybody who's done any research on transition economies understands immediately that the fiscal deficit ballooned, and on top of that, banks were saddled with non-performing loans out of this restructuring. So how did China clean up? At that time, there was public money. Actually, it was reserves, foreign reserves, very interestingly. It was dollars being used to recapitalize the banks, but never mind. There was lots written as to whether that should have been the case, never mind. But there was public money. On top of that, they took assets out of the banks, transferred to newly created asset management companies. Yeah? And added value that was not necessarily market value, let's face it. Starting with face value, going slightly down, but these asset management companies never recovered anything similar to what they paid for. So there was already some implicit additional, because these are today actually they're listed in the Huarong, but at the origin they were quasi-government agencies. And on top of that, foreign investors came along as strategic investors, so they put some additional capital, and there were IPOs for, kind of more diversified investors. So these four types of phases. And they did bank by bank, so, China Construction Bank, Bank of China, ICBC, the last one was Agricultural Bank of China, which started only in 2008 in the midst of the financial crisis, and nobody ever knew how it ended, actually, because it in a way, it came too late in the game and at a very difficult time for China. But we kind of, and we wrote a long paper on this as to the cost. This is a lot of detail of who put the money. It was relatively complicated to even figure where the money was coming from. Never mind, there was public money. And we estimated that the whole process of public money being restructuring or the transfer to asset management companies was something of the other 20% of 2004 GDP. So the first three banks that I mentioned, excluding Agricultural Bank of China.
Central government?
So CIC, so it was again coming from the reserves. They created a use Huijing, which is like a SPV of CIC to recapitalize the banks. Yes, but central government, yeah, central government money. So now all of this helped a lot to reduce the NPL ratio. So you can imagine, of course, remember, the NPL ratio is a ratio. So because credit kept on growing, that also helped a lot because the denominator kept on growing. So this is the miracle of China's bank reform. This is not Japan. When your denominator grows 10%, even more, yeah, a year, nominal growth in China, even 12, even 14 at a certain instance, 2010. I mean, sorry. I'm not saying that this was not hard, and I really admire the Chinese authorities who did this, but frankly, when you have nominal growth, everything can be cleaned up. Sure. If you're clever enough not to do too many mistakes. But it's much harder when your denominator does not move, yeah? And this is really when you are stuck. So the key question is, then will there be a time where the denominator will not move in China, where this natural restructuring process, because credit growth is too high, will not be as easy? We're not yet there. So the second bunch of restructuring I'm going to talk about is still in this nice growth story that we were then. It was not only easy, and again, I still admire those who came up with these nice ideas because it's quite sophisticated, but I'm just saying it was easier than in Japan. On top of that, financial repression was still present because China had not yet fully liberalized interest rates. So actually, interest rates were extremely low for China's growth. So the natural rate, that graph only tries to show where China's natural rate should have been. If you think of a country growing nominally 10%, that's your interest rate, 10%. But it happened to be, much lower. So there was a lot of financial repression helping out to restructure because the deposits were trapped in a low interest environment. This is slightly less obvious today in the current restructuring, not as easy, because the deposit rate has been fully liberalized. It's not as cheap for the government. So then what happened? The global financial crisis headed, and we had this massive credit binge. Why did we have it? Well, because rightly so, the world was collapsing, and China had these nice instruments, which were the banks, to accommodate the credit growth needed to support the economy. How? Through local governments, which were through local government financial vehicles, investing in infrastructure, and also corporate state-owned enterprises, in particular, investment. So it was a massive investment boom. That's when China stops being driven by external demand and starts being massively driven by investment, this investment growth model that we always talk about. And the banks were the intermediaries of that model. So at every point in time since then, so it's hard to see that graph, but I hope you can understand it. GDP growth was pretty intense, as you see, 2009 recovering to very, very high levels. This is nominal GDP growth. So you see there the 15% I was talking about, massive. 2010, very high nominal growth. But credit was growing even faster. And if you move beyond banks, so total social financing and other measures of total credit in the economy, at a point, it was growing 35%. It was an absolute credit binge of dimensions that probably the world has never seen, frankly, in recent economic history. And that is what you see with the credit to GDP, or who was getting the money, mainly corporates and local governments, as I mentioned. So what happened next is that, this is just a measure of the fact that, yes, I'm focusing on banks. Do not forget, though, that all of this shadow banking that was created, that you may have heard about, China having this massive non-bank financial sector, a lot of it unregulated, not all, was growing also very, very fast. to the point that, in the highest growth years, 2010 to 2012, was about 18% of total credit. So now, who is behind this? To a large extent, the banks themselves. They were the largest issuers of shadow banking products, in particular wealth management products, as you see in that graph. So whoever thinks that here's the shadow banking, here's the banking sector, no. I attended a conference in Beijing in 2012, and the banks were so positive on shadow banking, and to me, I just couldn't understand, I mean, I thought they would be fiercely opposing. Right. No, because, basically these were the same groups. You had the trust companies. So it was really, the idea was trust, which are the second largest issuers there of wealth management products. So I have a client. My deposit rate is capped, because at the time they were capped. I can't offer anything decent to you, so I send you for a fee, referral fee to my trust company, which issues a wealth management product for you. And by the way, I can't offer credit to real estate developers anymore because I have, again, a limit from CBRC. So I send my client to the trust company who will invest in that infrastructure project with the money of the client that I couldn't serve because I couldn't offer the right, return on his investment. So fee income actually for Chinese banks ballooned. The net interest margin came down and the fee income ballooned. So it was a model that actually appealed to everybody. And I think that explains its growth story, because there wasn't necessarily, this was at the beginning. Of course, later, things got much tougher for banks, and they wanted their full money, and they started to oppose. But at the beginning, it was very comfortable. So it grew very, very rapidly. Yeah, sure. So now, on corporate debt, and everybody talks about corporate debt, whether this is sustainable in China, blah, 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 what banks are going to do. Well, the reality is that it was all about how your profits, how much money you were making that would allow you to borrow more. And the key of the second restructuring phase, which I'm going to hopefully go through very quickly, started when those profits disappeared, because they could just not serve the debt or the credit that they had borrowed from the banks. That's when the need for the second restructuring comes up, which is basically 2013, 14, heading up to the horrible 2015, where really we had, just to give you a sense, zombie in the way they define it, corporates. So EBITDA to interest expense below 1, meaning they could not even serve the interest. At some point in time, 20% of Chinese listed companies were in that situation in 2015. So you had to clean up. And how did they clean up? So I'm going to move very quickly, jump a few slides. When they hit the wall, i.e. the profits came down, how did they clean up? How are they cleaning up? Because it's still happening today. The first phase, jump, sorry. I need to choose my slide. So you see return on, the banks needed, the net interest margin was coming down very aggressively. The deposit rate had been liberalized in 2015. Everything was making the banks hit the wall. The return on assets, the return on equity, everything was. There's a lot of a dual story here because state-owned commercial banks were doing better than the newly, the most private ones. But what did they do? Of course, solvency ratios were starting. There was no more organic capital being created, so they had to literally, flood the market with issuance to basically be able to cope with the capital needs to keep their balance sheet growing. This is very important for Europe as well, because this is going to continue. We heard in the IIF conference that, and this was only a thing for joint stock commercial banks, if I'm not mistaken, you may correct me, Jenny, something of the order of 600 billion in capital needs coming. This is going to flood the market. So, for European banks, especially cross-border, so euro, especially if they want to raise euro-denominated capital, it's going to be very expensive because there's going to be massive issuance from Chinese banks going forward. And this is not new. Yes, jumping to how they clean up. So two parts of the cleanup of the 2008 to 2012 credit pinch. as I said, there were two origins of this massive credit: local governments and corporates. So local governments, what did they do? They did a credit to debt swap, meaning the local governments or the vehicles had a loan with the bank. Sorry, give me the loan, I give you a piece of paper. Yeah, and the government will guarantee to some extent. So they started substituting those loans with, because of course in regulatory terms of capital needs, etc., is of course much cheaper. The consequence of all of that, this is the amount that was cleaned up. I'm rushing, sorry if I'm not being very clear, but basically these are relevant numbers, and this is percentage of GDP. That credit binge for some, and we have the national audit having calculated more or less how much it was. Some people put it all the way to 30% of GDP. So, they've cleaned a recent part of that. And bear in mind, though, that this is pushing down banks' profitability because, of course, the bond paper is not going to pay you what the local governments thought they could pay you with a loan. Yeah? So it's going down from 10% of average interest rate to not even 2 or 3. So below, basically, refinancing rate of the PBOC. So very, very low for banks. So that hits their profitability. The other way they're cleaning up, and I finish here just the thing on Europe in a minute, is corporate debt. How are they cleaning up corporate debt? They're only focusing on state-owned enterprises, especially overcapacity ones, and only state-owned banks. So state-owned banks, which had a loan, say, with Huarong NT, the first debt-to-equity swap that happened, or Sino-Steel, a massive default, but it was never a full default because, basically, say Sino-Steel, it had massive amounts of loans with the banks. Here you go, I give you equity. So I'm now the owner of your, partial owner of your company. And the beauty of these debt-to-equity swaps, as they evolved, not the first one, which was full equity for the bank, so very costly in terms of capital, as you can understand. Their own, they realized this is too expensive. We create an SPV, a little, thing there that we do, of course, not consolidate and just put it there. And in that way, they've cleaned up about 15 to 20% of problem loans in China already. And nobody sees the consequences because it's at face value, so the banks don't lose anything. The company gets new equity. From where? From maybe a lifer or an asset management company, so from the rest of the financial sector that is investment through the SPV to put the equity there. So it's kind of beautiful, It's like, oh my God, how did they come up with this idea? It's like so cheap in terms of very different from the past. No public money, but as we say in Spanish, you bury after, below the carpet. Now, the problem is China's carpet is pretty tough. Why? Because you're growing very fast. So that loss there keeps on shrinking in terms of your GDP. So as long as nobody sees it, keeps on shrinking until you just smash it. This is the beauty of restructuring with high growth, which nobody can afford, except, probably China, very few other countries. So I think this is very, very interesting that what looks crazy, if you think about it, it's like, to some extent, even households buying these products that are then put into the equity of a company that supposedly is insolvent. Yeah? But the thing is, if you give a principal guarantee for 7 years, actually, they could even pay your principal, but you've lost 70% if your nominal growth is so high. It's like really, a lot of it is the fact that you're dealing with unsophisticated investors, that you're doing it in a very, very complicated way, and that it's allowed because you're not consolidated. The regulator is not asking you to consolidate your balance sheet, so you can do it. And maybe, frankly, to be frank, if I were a Chinese policymaker, maybe I would choose this option because it's less costly than in financial crisis, and it's probably less costly in terms of public debt than just injecting again. Because when they injected, the banks were 5 trillion in bank assets. Today, there are 40 plus trillion. So you need so much, such an increase in public debt that you cannot afford. So I'm just going to go to the conclusions before Guntram stops me altogether. So this basically compares the two restructuring options. Now, on the conclusions, one thing that, of course, the Chinese government can do going forward is to open up to foreign competition. Why? Because first, they need to divest so many assets. So there's a lot of securitization happening now in China. And for that, you can understand that the opening up to asset management companies, even to insurance companies, is actually quite interesting. I'm just pointing to the fact that foreign banks and foreign institutions, other than those operating with joint ventures, are making no money in China, sorry to say so. It's going to be pretty tough to find foreign investors other than with nice joint ventures. Yeah, you have Belgium Ageas with Taiping, that's great, because Taiping is a state-owned insurance company, you make money, it's great. But what about those that are alone in that very competitive? So what I'm showing there is that the cost to income is double, and that the return on assets is half. So it's not going to be so easy to find foreign investors. Maybe in the asset management industry, maybe in the insurance industry, maybe with a joint venture, but I think just go there on your own. It's not going to be. And by the way, the assets of foreign banks in China have only gone down to now a mere 1.3%. You cannot even see them. Because how can you cope with the growth of the rest of the system? You need so much capital, it's so expensive. So I don't think opening up, I'm not saying they won't, I'm saying it's not going to change the picture massively. It's not, China is too big for the rest of the world, put it this way. We can't possibly cope with the growth of this banking sector. But what they are doing, and this is very important for Europe, this is my key point on Europe, is going themselves abroad. Why would you not go abroad if your return on assets is low? If you know that, frankly, next cleanup is going to be harder because growth will be lower, because the system will be massive. So you may as well go out now. And this is why overseas loans are growing and growing and growing, and they will continue to grow. And policy banks in particular, the Belt and Road Initiative, they're all lending abroad. Yeah? Only Latin America, there's figures of 150 billion. It's just massive. China's will become, to me, I'm telling you now, although we don't have statistics, I hope China starts reporting to the BIS because they're a major lender today. They only report as a recipient, but they become a major cross-border bank lender. So please report to the BIS and show the world your lending arm, which is massive. So they will probably become the largest lender. Now it's European banks still today. So what are the things for Europe? Chinese banks, especially state-owned banks, will be reinforced from this current shake-up because they're the ones being cleaned up for nearly free. You see, they are the ones disposing the loans at face value. Somebody else is the equity holder of that. So they're going to be stronger. I even think, and we discussed this yesterday, will be even more consolidation in China. So maybe smaller banks will be absorbed by larger and thus state-owned banks to avoid any kind of liquidity risk or any kind of event that could happen. So they're going to be much stronger, from a very strong standpoint that we are already at, like in terms of lending capability, especially overseas. And because their regulatory environment is certainly not ours, and I'm not saying that the regulators are not doing big efforts to catch up on TLAC, on you name it, but certainly we're not at the European level whatsoever, they have a massive comparative advantage. They have a massive comparative advantage, and they have the government, in the same way as during the global financial crisis, they were pushing them to lend. Now they're pushing them to lend abroad. They're pushing them to go to Pakistan, China economic corridor, 50 billion, Russia, gas pipelines, 70 billion, you name it. So it's going to be very difficult for European banks. This is my main conclusion, to compete in third markets. So the shrinking of European banks' market share in cross-border lending, don't be surprised. It's not only about European banks' inability or regulatory environment, which I'm not saying is not relevant, it's because there's a massive competitor today that was not there before. And I'm not saying this is bad or, life changes. We all have to get used to different competitive environments. It's not a criticism to China whatsoever. But I'm saying, I think it would be important for us to realize, because I have the feeling that sometimes it's like we focus so much on regulation that we don't look at different competitive landscape that is there today, and in good part, not only because Japanese banks are also there, big time, but I think the China phenomenon can be of a size that nobody can compare with because of the 65 trillion I mentioned at the very beginning, which is kind of the target by 2030. So, if it's just going to flood the world with cross-border lending from China. So I leave it here. Thank you.
Well, thank you very much, Alicia, for this passionate presentation on China and the Chinese financial system. I'm now pleased to host a panel debate, and our first speaker will be Jean Ma, who is head of China research at the Institute for International Finance and has worked previously at ISI Group, CITIC Securities, as well as the Chinese Ministry of Finance. And has had visiting professorships at University of Illinois and George Washington. Jean, I'm sure you have lots to say on this topic, so we very much look forward to your comments.
To be here. I have heard so much about Bruegel and I read so much you published, but that's my first time to set my foot in the door, be here in person. So really an honor. So Alicia gave a really nice presentation about the status change of the China's financial system. I may be able to shift the focus a little bit, talk a lot more. What does that mean for the European countries? What are the opportunities and challenges? First, we have 30 members in China, the banks, insurance firms. They really love to learn what happened to the European financial institutions in the past decade. Because the experience in Europe is a lot more applicable to China than the American experience, because he is also bank-dominate the whole financial system, like China. So for example, I don't remember how many times those people ask me, do you have any research of how Spanish banks survived the boom and bust of a real estate cycle? And how the European banks deleveraged, recapitalized, disposed of the bad loans. Can we do anything in Italy in the bad loan business? So they really care a lot about the European experience. And I also think there's a little or less political barrier between the cooperation of the European financial institutions and the Chinese institutions. I can give you a few examples. Take example of AIIB, the Asia Infrastructure Investment Bank. Britain was the first non-Asian country to sign up, right? It's right now also hold the vice president position. And the French also hold a vice president position in IB. However, US just too shy to join that club. In my view, I think there's a pretty good chance in the next 2 or 3 years, Japan will also join AIIB, then the US will be the only one left out. Same thing with the Belt Road. US, there's even people working on Belt Road, but that's to put roadblocks on those roads or cut off the belts. But however, I was in London Monday, Tuesday. There are at least 2 London asset management companies that are setting up Belt Road Fund. I'm so surprised. I don't know where they can invest, how they can invest. But anyway, this is good for the marketing. They can sell this fund. I suspect they probably disinvest in the bonds issued by the Chinese companies doing business in the Belt Road countries. And for example, London is working very closely with Beijing to set up a so-called the Shanghai-London Stock Connect. Right now, currently we have Stock Connect between Hong Kong and Shanghai. Beijing love the scheme because they think this is not a capital liberalization, it's just a managed liberalization, okay? Because you can imagine when they allowed Chinese people buy Hong Kong stocks, the moment you liquidate your Hong Kong stock, money flow back onshore immediately, right? According to the design of the mechanism. So there's no leakage in the stock connect. So Beijing liked the idea, and then London think, well, after Brexit, we need to do something to protect our financial center status. So they also want to jump aboard. So for example, China also extended the trading hour for foreign exchange to overlap with the European hours. So that means theoretically, even right now, the trading volume is still very thin. It's just started. Theoretically, a foreign exchange trader in London, hopefully later on also in Paris, they can basically trade China's currency onshore from the seat in London and Paris through the Connect system. They're working on those things. And I just cannot imagine such a Connect system, such cooperation can happen between Beijing and Washington anytime soon. Okay. Now, regarding the opportunities, let's first focus on what can we expect Chinese will do in Europe, and also then what Europeans can do in China. Right now, we are seeing a lot more foreign direct investment from China into Europe. There are happy stories, there are not so happy stories. So I think so far, most of the FDIs are still in the manufacturing sector. Not exactly. They also bought 10% of Deutsche Bank. And then I think in going forward, we may see more such investment in the financial sector. Right now, what have seen so far is that, say, Hong Kong Stock Exchange, they bought London Metal Exchange because China's a large commodity user. So they really want to have a say in the commodity pricing. On Shanghai Stock Exchange, they right now acquiring stakes in the stock exchange in developing countries, like say Karachi or those Southeast Asia countries. And I think they're also very actively talking with exchanges in Europe. If not acquire some certain stake or set up some joint program. So a lot of things going on. Then regarding the opportunities in China, as I just said, doing business in China is always like this, because nothing is easy, but at the same time, nothing is impossible. Okay? So most people think, well, it's impossible for foreign hedge fund to do anything in China because of regulations. They don't want a hedge fund. Then wait a minute, how much money Bridgewater is managing for China right now, right? Because they have the right connection. I think, so in terms of the financial market and the product, the bond market right now is already wide open. In fact, I believe Europeans made more money than the American investors last year by buying Chinese bonds, because if you buy the right bond, offer you 4 or 5% yield, and RMB appreciated a little bit last year, you can get almost close to 10% yield on investing in Chinese bond last year. Equity is much difficult. China's stock market is big, extremely liquid. It's the most liquid market in the world. So there are some Russian doing quant trading, high frequency trading in Shanghai. They made boatloads of money because it's very liquid, but at the same time it's very volatile. It's hugely volatile. It takes years to climb up, and that came down in 2 months. So it's a bit much more difficult for foreign investors. Now, in terms of institutions, what can I see? As Alicia says, no doubt, the banks are having a much tougher time over there. Not only because the capital base is not big enough, and also the risk appetite are quite different. So, for example, the Chinese banks made a huge amount of money by lending to the property sector in the local government, because they see, well, they have some implicit guarantee by the government in Beijing, that they are willing to take the risk. But for the foreign banks, foreign investors, these are taboo. There's no touching zone. So it's much more difficult. But at the same time, I see two opportunities for the foreign financial institutions. French are very keen to tap into the derivative market. Right now, the China derivative market is still relatively small, but I expect to grow very quickly. For example, Shanghai just launched the crude oil futures, denominated in RMB, settled in RMB, but that's the very first commodity derivative available for the foreign investors. And the French believe that they just they're much better at the mathematics than Americans. So even in the American banks, it's just the derivative desk are full of French. So they're very keen to do the derivative business onshore in China. Asset managers. Right now, because asset managers can obtain a so-called WFOE license, wholly foreign-owned enterprises. So that means you can do your business without a joint venture partners. If you do not want to give up your trade secret, you can set up your own wholly owned enterprise. I think right now there are 8 asset managers have as a WFOE, went in as WFOE, also acquired a private fund management license. That is, you can sell your product to the Chinese qualified investors. There are 8 acquired a license, 3 are issuing products right now. Right now, it's still small because you do not have that name recognition. You don't have the track record onshore, but they are starting doing this business right now. These are the opportunities I can see at this moment.
Thank you very much, Jean, for these comments and remarks. Now, our second speaker is Hu Yuwei. Dr. Hu is a research fellow at the China Institute of Finance and Capital Markets, and a department head of international finance at that institute, in fact, and has previous work at the BBVA, at the OECD, at various other institutions, World Bank consultants at World Bank, at the European Commission, at the IMF, and he's a frequent commentator in Chinese and international media. So, Dr. Hu Yuwei, thank you so much for coming, and we look forward to your comments.
Thank you, Chair, for your kind introduction. So first, I'd like to congratulate Alicia, my former colleagues at the BBVA, for this excellent paper. So I'm looking forward to read the 100-page papers. So indeed today personally I had learned quite a lot from the particular presentation. So even some news and data are quite new and for me and as well. First of all, thank you for giving this presentation. So indeed, I do have some comments. But given time constraints, I'd like to only focus on 2 topics or 2 issues I will share with our audience today. So first of all, regarding the current status or future of Chinese banking sector in China, because the main discussion today mainly focusing on Chinese banking sector. So I think China banking sector now is in a crucial time. So largely given the changing external environments, either in China and also abroad. So indeed, the banking sector now facing pressure, I think, in terms of profitability, etc. They are due to different reasons. That's my personal thought. First of all, for example, like Alicia just mentioned regarding the interest rates liberalization, etc. Indeed, now in the central bank, for example, now have been working on issue for a while. And now we are moving toward direction of full interest rate liberalization. So if now as we have happening now, we are seeing what is happening in China in banking sector. Indeed, the banks, including the big banks and also smaller banks, they are facing quite a lot of pressure from the particular policy initiative. Probably particularly for the small and medium-sized banks, because in terms of economic scale, etc., they are not so competitive to the big 4 banks in China. So probably the trouble is more for them. I think that's referred to what Alicia mentioned, the market consolidation in China. because they are small, they are smaller, they do not have much support from central government. For example, they are facing, for example, declining the client base, etc. So the problem is more for them. So that's first issue I'd like to mention, which I think directly linked to the current developments of our banking sector in China. So secondly, I think I also refer to the rapid, probably tremendous growth of the high-tech company in China. I think yesterday, over the past 2 days, some of our colleagues here also was in the IIF, meetings. So my impression is that, in Europe as well. So most of the audience or the speakers, they mentioned quite a lot about growth of the high-tech company, impacts for the financial sector. Probably this issue is, I think, it's probably more urgent, serious in China. Maybe you heard about the name of Alibaba or Baidu, among others. So indeed, I think in China they are competing very strongly with the traditional banks, even including the big four banks, like ICBC or Bank of China, etc. Now I think they are feeling the real pressure from them. So in terms of the client, in terms of the commission fee, etc. So indeed, I think they are feeling quite strong competition from them. So my understanding that at the beginning, they wanted to use, for example, to lobby to the central government to control, to contain the growth of the high-tech companies there and their business in the financial market. But now suddenly I think over the past couple of years, the big four banks, particularly, they're getting more open, to these things. So I think that's kind of the natural financial illusion in China, revolution in China. So no people can stop this. Having said that, that means so far all the big four banks, now they are patterned with the big, four high-tech company in China, including Alibaba, Baidu, etc. They set a joint venture, the joint venture on banking sector. So in that sense, so they want to take advantage of the platform, the strengths in the particular issue, then to jointly, develop in China. So, but in any case, I think the traditional banking sector and business, they are facing pressure from the platform as well in China. A third issue I will mention regarding the aging population. So I think somehow the aging population also have a big impact for China as well. In the presentation, Alicia mentioned the saving rate in China. Saving rate, of course, including public saving and private saving rate, etc. So here I have some data, regarding deposits. The bank deposit in China. In 2016, the total bank deposits was 150 trillion RMB. The growth rate, the year-to-year growth rate was 11%. And 2017, the total amount of bank deposit was 164 trillion RMB, and growth rate was 9%. So we can see, the bank deposits now have been declining. I mean, of course, there are many reasons to explain this. But I think one of the reasons because China is aging. Actually, China is already aged. Maybe you're familiar with some data. So 11% of the Chinese population now is about age of 65. So which refer to a population of the 160 million people. I think this amount roughly, equivalent to the combined population of the two biggest, EU country, Germany and France plus Belgium. So, only the age population now, equivalent to, the whole population of three, important countries in the EU. So we also know that by theory and by international experiences, so when China is aging, probably we're still in the asset accumulation process. And also given the traditional China people like to save, but they put a lot of money in the banks. But now I think China somehow is in the transition. We are in transition of the decumulation. That means China, age population, which they are going to spend money. Actually, that also explains why Chinese currently the consumption now it contributes the bigger share of the GDP compared to the past decades. So here is about 3 points I'd like to mention. They are the 3 important factors behind the developments of the banking sector in the future. I think they are quite important. So second issue I'd like to touch on refer to the business, the potential business for foreign partners, either abroad or either in China. Further, again, regarding the banking sector, again, in one of the slides, Alicia mentioned that the banking asset, foreign banking asset now only accounted for 1.3% of Chinese total banking sector, unfortunately. So we used to work in the same BBA bank, so we know the main story behind that. But that was the past. That's our story. That means if we're looking forward, so my understanding that starting from this year, the China, I think now more committed to open up the policy, the market to the foreign the companies. For example, now I'm sure some of you are familiar with that. Recently, including the banking regulator and also now the banking and insurance regulator and the security regulator, we announced a big reform proposal to encourage more to increase the market accessibility in that sense. And also at the same time, recently I talked to some friends or colleagues in the Chinese banks. I just asked them, so what's your view about recent financial liberalization, for example, in the banking sector? I think many of them, they frankly speaking, they said they are feeling the pressure. They're a little bit concerned about what's the future we develop in the future in China banking sector, because they are working there, so they probably know more news or they have more feeling about the particular issue. So I think foreign international companies of banks still have their advantage strengths in working in China. Hopefully in the future, the proportion of the foreign asset in China could increase. Secondly, going out, and also we mentioned quite a lot about the One Belt, One Road initiative. So personally, I think, indeed, that's the huge investment gap, in terms of the One Belt, One Road initiative. I remember that, the ADB, the Asia Development Bank, they released reports mentioning that, between 2015 to 2030, the investment bank, the financing, the gap along the One Belt, One Road initiative could be more than 26 trillion. 2.6 trillion US dollar, a huge amount. Having said that, the Chinese government cannot finance everything. So even now, particularly given the current, the strict financial regulation, I don't think Chinese government, or the investment, the army, etc., can finance all of the funds. Having said that, we also at the moment we are looking for diversify. We want to raise more funds from international markets. That's the first point. Secondly, I think we want to also diversify the way to finance projects. Before, most funding are mainly from banks. That means from the bank loans or etc., either from the policy banks or from the big, big four banks, etc. But also now we really want to encourage, participation. We want to encourage the way of the equity financing. So we also want to, or consider the feasibility or necessity to raise more funds from capital markets, rather only financed by bank loans or bonds, etc. So in that sense, for sure, in China, we also considering different, international markets, etc. To have to really diversify the funding, the methods, and also in order to reduce the risk related to this particular the case. So yeah, let me stop here. So maybe we can interrupt later.
Yeah.
Thank you.
Thank you very much. Last but not least, I'm happy to welcome Elena Flores, who is the Director of International Economic and Financial Relations and Global Governance in the European Commission's DG ECFIN, and is a sort of a well-known expert on global financial matters, with a distinguished career in the European Commission, and she will reflect, I guess, on what we think of all of this from a European point of view. Thank you, Elena.
Thank you very much, and thanks for inviting me and the nice words of introduction. I don't think that I would qualify myself as a financial expert. Far from that, in particular, having heard the other participants this morning, and thanks to Alicia, because it was very rich and really triggering to read the full paper, because I think there are a lot of very interesting findings. So to complete a bit what has been said and bring a little bit of a broader angle, I would say, I was looking at the financial sector in China in terms of what that has meant in the macroeconomic developments and what can that mean for Europe as well in this respect. So with the interlinkages between financial sector and some other parts of the economy. So the way we see it is that indeed the financial sector, and that has been said in China, has played a major role in the development of the growth model as we know it. And I would say it has been a very critical vehicle for state intervention in the economy. Alicia very clearly explained that. Politically driven allocation of capital, and as a consequence, the build-up of major imbalances as we know them. So that's a bit the background in which we are looking. And as it has been said as well, it is now in a critical juncture. And I think it's both for China, but also it will become much more significant globally if really the way goes to opening the financial sector and being much more active outside, as it has been seen in latest developments. So against this background, I would raise 3 points basically, or maybe 3.5. One is the interaction between the financial market dynamics and the growth trajectory. Clearly, as Alicia also said, the financial sector has been used as a counter-cyclical policy tool. And this has been seen in many instances. Last one, 2016-17, clearly a large-scale stimulus introduced after the global financial crisis, and using state firm investment clearly as a counter-cyclical to pop up demand. That has obviously good consequences in terms of growth, but not that good in terms of what kind of investments and what is the return of these investments, not only in the short term, but also looking forward. So the banking system has been driven by, to a certain extent, economic policy decisions or objectives, not only by direct investment, but also by kind of pressure to lend to state firms that then do the actual investment in the real economy. So what we have now as a situation, and already these two cleaning processes and maybe the third one coming, is the result of that. So a lot of assets with a very low return, low quality of products, and that seems to me that going forward, given the increasing constraints in terms of what are the actual potential returns in the growth developments, the quality of the assets becomes much more important, because it's not so easy to get that growth as in the past. So this quality of assets is a real issue, and here I think there is an interlinkage between, what is the kind of growth model that will be developing in China. So this is my second point. I see the link between the financial reform and overall reforms in the economy. So depending to the extent that, for instance, the development of the new technologies and all these forward-looking sectors is going to be done in the same way as in the past, so with a clear state-led direction, and therefore a clear state-led using the financial system to push this particular industry. So it will be a bit of new sectors, but the same kind of model that it was used for the old sectors. So that's a question mark. So that will depend on that. So that is clear interaction between how the financial flows will be put into the economy to drive these new growth sectors. A second point in the same block is the question of I'm thinking about the possibilities for foreign investors, etc. in China, is the issue of the level playing field, and in particular, what is the access to finance for local firms versus non-local firms. And there, obviously, the role of the financial sector will be also crucial. And whether this offering of finances from the banking sector or from the financial sector will be driven purely or mainly by commercial criteria or not. So that's the point. And also the issue of implicit or explicit guarantees that play a role in how the financial sector interacts with the real economy. So there, just to summarize, the link between financial reform and overall reform in the economy. The third point is more looking on the global, the impact on the global economy and global markets. And here there are the two aspects, as were mentioned, the inflows and the outflows. So the landscape has changed a lot, and there is a sharp rise in outflows and a corresponding fall in China's foreign reserves for that reason. So at present, China is acting to support the renminbi, has actively resisted sharp devaluation, but that also means a certain impact on external surpluses. It means also that China continues to rely on domestic investments very much to maintain demand, with the implications for imbalances that we know. So if China opens up capital markets, let's say, too quickly, if we can say it like this, well, we know that they may have implications, as we have seen in other parts of the world, because are there the regulatory and supervisory instruments ready to manage these inflows in a balanced way? At the current juncture, I would say no, but it depends how this opening, the speed of the opening and the sequencing evolves in relation to the evolution of the regulation and the regulatory framework. I think that the question that was slightly touched by some of you about the outflow of capitals, the investment abroad, and the increasing lending role of China, etc., brings me to a point that I didn't thought about mentioning it, but it is all these discussions that we are now having at the global level in terms of transparency, in terms of to what extent, the fact that China is becoming a very important lender means that all these issues should be tackled not just by own decisions of China or own decisions of somebody else, but these important lenders should be more and more part of the global fora where these questions are being discussed, should be more and more incorporating the reporting requirements, the debt transparency, and all these aspects. So without going at length on that, but clearly, I think there is a need to engage constructively at the international level, and I think it's the interest of all players, not only the others, but also China, because already now there are some countries that are really facing a debt default in the world, where China is one of the major lenders, if not the major, and I think that it will be becoming clearer that there is an interest also there to be part of a global management of these flows. Thank you.
Thank you very much, Elena, for these very thoughtful remarks and sort of showing also some of the thinking that European policymakers, of course, have on what Alicia described, what is happening in China. Alicia, I want to give you a chance to react to a few points and also open up for a few questions. But let me also add my one or two small points. I guess my first point is really on the savings rate, because in a sense, all of this is driven by an extremely high savings rate, right? If you have a savings rate of close to 50%, necessarily you will have an increasing financial system, and necessarily there will be bad investments, and I think you described that, and necessarily there will be pressure to invest more and to invest more also abroad and channel some of the savings abroad. So I guess my first question is, where do we see the savings rate going in the next 10 years? Because if it stays where it is, there will be more restructuring, bad loans, there will be more bad investment, there will be more bad investment also abroad. And at the same time, of course, there will be also quite some growth. So it's really this trade-off, but it's a sort of starting to be quite an unhealthy way of doing it. Perhaps you can give some remarks on that. Now, my second question is on the role of the state, and if you could say a little bit more about this. So I think you showed basically 50% or so of the financial system, or at least of the banking system, is more or less directly under state control. I understand it's mostly central, but also the local entities play a role. Now, on the other hand, there is sort of this notion of market discipline, and can markets ensure a better allocation of capital? And so you have those two competing forces. And Elena, I think, was also pointing to that it's a political vehicle, the financial system, for doing certain things. And at least in our philosophy, we would say, well, if that becomes too strong and too permanently part of the economy, there will be a lot of bad credit, a lot of bad allocation of capital, because things will just be driven by political vested interests instead of real economic needs. So how much is that changing? How much is the state's role changing in the banking system? I guess my third point is on. I think you mentioned it on the Alibaba and the new platforms and so on. The fintech industry, as you know, the biggest fintech industry is in China, in the world, by far the biggest. The argument that is always given why it is so big in China and why it has so grown so quickly in China is not just market size. Of course, you leverage and you can immediately sort of tap hundreds of millions of consumers, but it's also the fact that there is this view that the Chinese financial system is underdeveloped in the sense of providing financial services to I guess ordinary citizens. So where's China's financial system heading on the front of being a financial services provider? We know state-owned financial system give big credit for big investment projects, this we know. But what about the financial services for citizens, which certainly must be absolutely critical? Perhaps you want to react to what you heard, and then let me see, how much time do we? Yeah, let me get a few questions from the audience who took lots of notes. So I have Marek from Bruegel.
Okay, Marek Dąbrowski, Bruegel. I have a question which follow-ups Guntram's question about savings, but not only savings in the context of demographic transition, which China just started, quite dramatic. Is it not the risk that China will repeat Japanese scenario of 1980s, let's say, with rapid demographic change, which led to slowdown of growth and also savings or declining rate of savings, and what kind of consequences it may have for financial sector? And the second question is with respect to what you thought about some broader narrative which was very popular at the time of global financial crisis, that China must move from export-oriented growth to domestic demand-oriented growth. But I didn't catch well from your presentation whether this kind of transition in growth model will be really helpful for financial sector, because my concern is that as far as you orient for external demand, still companies must meet some criteria, competitive criteria. When you start stimulate domestic demand, then you can have, as we saw, a lot of politically driven investment projects, or politically driven, for example, social project, which is not still the case of China, but it may be also some case. Thank you.
Thank you. The gentleman here.
Thanks a lot. I have a question
Please
regarding...
identify yourself.
Tim Rüdig, European think tank Network on China, on behalf of the Swedish Institute of International Affairs. My question would be about the role of the state, implicit credit guarantees, and maybe also the question of credit pricing, because you have been describing very convincingly this basically state permission, both on the financial side, but as well on the side of recipients, actually, of loans. And you've also already said that the next cleanup will be more costly due to reduced growth. So my question is basically, do you see signs that are promising from the party state of actually tackling the issue of implicit guarantees and of and then improving credit pricing to actually then tackle the root causes of what we have seen the last couple of years to basically, well, your predictions seem to be not that optimistic that we won't see something similar happening again, but still I'd be interested in what kind of policies you see in that field. Thanks.
Gerhard Stahl, I'm visiting professor at the Peking University HSBC Business School and former colleague of working in EU institutions. I have two questions. One question is for the Chinese participants and maybe for Alissa. It concerns the need also to find financing for the internal development in China. We have heard a lot of examples of financing activities for the One Road, One Belt and FDI outside China, but there's this big challenge also to develop the rural part of China now. There are a lot of aspects related to this which are not financial, like ownership of land, etc. But there's also a financial question. And in the further development of the Chinese banking sector, are there also reflections how to learn from some of the interesting European examples? We have regionalized banking system, for example. We have cooperative banks who are very good in financing small projects in a more decentralized manner, also in rural parts. And my question is a bit, what is the thinking to help also these internal developments via a specific development of the banking sector? And then my second question is related to Elena, and you have to decide how much you can share. And this is, we have heard the difficulty of the regulatory differences. And this is an issue which we have on all levels cooperating with China. There is since 2013 an effort to come to an EU-China investment and trade agreement. And it would be an occasion at least to address some of the regulatory aspects. And my question is, Elena, are there some indications how these negotiations are going? And are there also some aspects which we might link to the financial sector? And then maybe a more specific question even, if one looks to this Chinese situation with a lot of pilot projects and different rules, how to cope in an EU-China agreement with the specificity of China, offering certain things on a specific level, and how to include such specificities into an EU-China agreement. A bit too many questions, I agree, but some maybe quick answers.
So there's behind you, there's then I think
Yes.
closer.
Hello, I'm Augusto Soto from Dialogue with China project in the south of Barcelona. Just a brief question for Mrs. García-Herrero and Mr. Wolf. Simply, which are the challenges for the for our banks along the Belt and Road Initiative and the challenges for the Chinese banks? We're talking of unilateralism, we're talking of an opaque mood from China's side, according to some analysts in Brussels, Berlin, also in the wake of the visit of Angela Merkel in China now. So thank you.
Thank you. Okay, I think we have to close on the questions. Alicia, you have a first go, and then each of you gets 1 or 2 minutes to pick what remains.
I simply can't answer all the questions because
You focus on the key.
Yeah. So I'll be very, very brief. To the point that you may not understand my answers because there's so many questions. But in a telegraphic way, saving ratio, of course, coming down. This brings me to Japan. There's no way that China's saving ratio can be as high. You already mentioned that in the light of aging. But, you know, China's aging today is not comparable to Japan's aging today. So we're talking about Japan shelving off 1 percentage point of its labor force every year. China, you need to wait to 2035 to get there. So
China's like Japan in the 80s.
yes, that's right. So basically, we are 20 years, close to 20 years still. So that process won't happen tomorrow. So I do think we're going to reach 65 trillion, in other words, bank assets, because the saving ratio is not going to come down aggressively tomorrow. What will happen in 2035 we can discuss, but I'm just saying it's not China is not Japan today. I mean, you're right, 80s, and that China has time to accumulate additional external assets, which I think is what China is after. It can be lending, it can be FDI, it can be anything on earth. What is more difficult, though, is that China, in the current circumstances, this brings me to the capital account liberalization, accumulates what China should be, in my opinion, accumulating even faster, which is portfolio investment, yeah? I mean, any Chinese household would probably feel very comfortable having a little bit of their eggs in a different basket. But that's where the constraints are today, which pushes the domestic saving ratio even higher than Japan, because Japan didn't have that issue. Japan has a massive home bias. We all know that, and it's been estimated. But it's not 100. In China, it's a forced home bias of 100. So this makes the saving ratio even higher than it ever was in Japan. So in other words, it will come down slowly, because we're not yet there, and second, from a very high level. So the banking sector will continue to grow in China. I don't think we can avoid that. And the internationalization will happen because of the return on assets is very low. So, yeah. So, of course, they should, in my opinion, for everybody's sake, of course, beyond the reporting to the BIS, we can also think about the Paris Club. You were referring probably to Venezuela. I mean, it's going to be a hard potato to deal with outside any. But, of course, you may argue that China and Russia, being the two largest investors in Venezuela, or lenders, may find it more appropriate to deal with that, you know, on a bilateral basis. Maybe that explains why we're still where we are. But indeed, I would fully agree with that. So that's the saving ratio, and yes, there will be a new phase in the light of the answer I just gave, because saving ratio will come down only slowly, blah, blah, blah. So I think we won't avoid one more boost of cleanup that will probably be needed at a much higher cost than it has happened in the last two instances. We are actually in the second right now. The role of the state, there were many questions on the role of the state. I have a firm view, whether I'm right or not. I think we have the regulators here, and they can, of course, claim otherwise. But I don't think China is ready to give up what to me is an almighty power that China has, which is the control, the firm control of any strategic sector. But finance is a strategic sector for China, because that is the instrument to obtain a number of goals. So my take is that you won't see a reduction in control. You may see less, in percentage, maybe, there may be, because it's very costly to keep this going, yeah? So you may see more IPOs, a slight diversification of the private ownership of the banking sector, but the control, in my opinion, will remain in state-owned hands, which brings me back to the need for a new cleanup when the time comes. But the thing is, this is a very simple calculation that I once thought about, and actually, Edward Prasad mentioned this to me, and I was like, wow, he has a point, as many times. If this is the thing, if you have a 50% saving ratio, China is growing too little. I mean, it should grow 20%. Basically, of course, there's a misuse of those kind of
investments.
Yeah, actually, trapped savings. Yeah, trapped savings to a large extent, have to be misinvested because otherwise growth rate in China would be double. I mean, it's as simple as that. But at least you get that growth rate. You know what I mean? Like, think about a Chinese policymaker. Yes, maybe, but what is the alternative option?
Well, but that relates to then the question of, what kind of financial services do you provide to customers,
Okay,
right?
but
And
they're
that's
solving that differently. Okay.
That's basically people are forced to hold their savings in low return deposits,
Yeah.
or and,
Well,
that's the way you can afford it, right?
Yeah, but this is becoming increasingly difficult because China is also pushing actually, when you talked about, I don't know, Ant Financial, so Alibaba's financial arm, or any of these new financial, I would even argue, monsters, because they're massively growing. So it must be very scary from the side of the regulator to see all of that. I think that in a way China is saying, okay, I keep this model because it brings me the growth I need, and I need to escape the middle income trap, and this is the way to do it. It may be a little bit costly, but frankly it's worked out. So I don't want to get out of the boat too early. I need to get there, and I can understand that. But on the other hand, they say, but I have this wonderful fintech or related tech sector that can offer the financial services to individuals, and it all looked very nice. But the problem is, of course, the growth of the non-banking institutions with the risk associated, unregulated, P2P became a nightmare. So now they're trying to square the circle by bringing, the single the asset management regulator, the merger of CSRC with the insurance regulator, all of that to bring it back to the balance sheet, what was literally, mushrooming everywhere, which was all of. But that's going to be very difficult because you'll have a hole, which is the capital. The minute you bring it back, you need the actual capital. So this is why I think, again, going back to European banks, I mean, that market is going to be so flooded with Chinese banks issuing to get the capital needed. That won't be enough because still the state-owned control needs to remain. So, it's going to be very tough to just put the money that keeps at least a share or so it's not easy, but they're trying this way, through what they call neo-private banks as well, trying to serve the households. And by the way, to a large extent, whatever is transaction is already done because all of the payment system is outside the banking sector as far as households are concerned already. So they're like leapfrogging, in other words. They won't have these retail banks that we have in Europe because they're leapfrogging that to neo-private banks or tech-related financial institutions. It's kind of a very big experiment for the world, actually. So that is market discipline. My views there. I think that's not the key priority now. I mean, to put it very bluntly, because if you really want market discipline, it's just impossible with the amount of state-owned ownership you have in China. It's just not going to happen. And I guess Japan, I answer implicit guarantees a little bit. I think is really what I already said. BRI, rural China, I think this is related, the two questions, because a lot of what is happening under the Belt and Road Initiative is rural China. So if you think about the Pakistan-China economic corridor all the way to Gwadar, this is the development of basically the west of China. So a lot of the money we think is going to Pakistan is actually also going to West China. I mean, it's like a kind of developing both at the same time. The only way to develop the West sustainably is to develop what is next to the West, yeah?
Sure.
So this is so I've seen analysis of the cut in both cost of transportation and prices, of course, and time, of shipping from Gwadar, deep port, all of the gas from Iran and, of course, Qatar, back to West China. It's just everything is going to go through that route. So, for the Malacca Strait, it's just this shipping. We had shipping companies in European Business Summit saying that we're not worried about it. If you never compare, I mean, they're focusing on, I don't know, maybe Chongqing to Duisburg kind of transportation. No, it's not Chongqing to Duisburg, it's whatever is in between Chongqing and Duisburg that makes the difference. And there's actually some, not many, but some highly populated countries on the way, Turkey being one. And I don't think you're going to go all the way to the Malacca Straits to there, let alone South Asia, which for many, and there's a very famous book on this, that's the center of the world in this century, actually, not even the next century. That's where the largest concentration of population will ever happen. So Wadar makes sense to me. So in other words, I just think that we think all of this is highly political and irrelevant. I think it's massively strategic and relevant. It's going to help develop West China, and it's going to bring new routes that we had ever thought about, that we were still shipping, basically going across the globe for things that are as close as this. So I do think that it could make sense. Yeah.
Jim.
I think Alicia answers it very well. I just heard there's one question about inclusive finance, and also mentioned something I forgot to say earlier. The China large banking sector is not designed to serve the rural population, and they want to serve the big infrastructure project. They don't have the experience. The rural household don't have the collaterals or credit history. It's difficult. And also, the hard task of poverty reduction still should be carried out using the fiscal policy rather than the financial credit policy. Now, but the ray of hope is coming from the financial technology fintech companies. Companies like Alibaba and the financials not only help them sell the goods, also really provide pretty good credit tracking. As long as you have a mobile phone, you have access to finance. That's the things are changing. One thing I forgot to mention early on is the opportunities for the foreign countries in China right now. Another thing, opportunity is using China as a funding source. The panda bonds so far still very small. They only issued about 5 panda bonds. The first one was the World Bank. I think all the rest of you were all European companies, Volkswagen, KfW. The panda bond is an RMB denominated bond. You raise the onshore, you can take money out. So far, still very small. I expect that to grow. The so-called international board, the chance for the foreign company to get listed in Shanghai Stock Exchange, that may be still a few years away. It won't happen anytime soon. The other thing is China launched a so-called QDLP program, Qualified Domestic Liability, Limited Liability Partnerships. That is for foreign companies, most hedge funds, but also large asset managers, when they have such status, they're able to get a quota, raise money in Shanghai, and invest money abroad. As Alicia said, with such a large saving and a low return trapped at home, the local population, they have a desire to invest abroad. So this is also a great opportunity. I think right now, like UBS, Nomura, Windtown in London, those companies already acquired, 20 companies have acquired such a status. But the quota is still small.
Okay, so let me quickly respond on a few points. First, saving rates. So probably my mentioned number of 160 million age population in China scare you, but I think we still have good news. First of all, starting a couple of years ago, Chinese government decided to relax, the 3 decades long, the one couple, one child policy. So now we have the policy. Now is the one couple, two children. So probably in the future, maybe this policy could be further relaxed. Secondly, I think Secondly, I think I'd like to refer to productivity. So why are we talking about saving rates? So because based on theory or based on a lot of research, we mentioned that for example based on solo growth model. So the economic growth depends on human resources, capital, and productivity. Maybe now in future, I'm sure China will continually age. However, probably the productivity will increase. So that's why, sorry about that, but let me come back into the technology. Because China, again, refer to Mr. Wolf mentioned. So why, Alibaba, growing so fast in China? So I think now the Chinese government now, more or less, they are quite open. They really would like to market, play a crucial way in terms of the asset allocation, etc. And that's why they are quite open, encourage, the high-tech company to develop in China. So if this trend could continue and could be in the next decade, etc., I think probably Chinese labor productive could be increased. So in that sense, so even China is aging, but if we productive increase, we still could maintain we remain GDP growth at a reasonable level. The first one regarding the saving rates. So if saving rate drop, probably eventually we don't have much negative impact from that. Secondly, I think regarding the internal developments, the professor from Peking University. So indeed, I think you raised a very, very important question in China. President Xi identified 3 key tasks for this year and probably for the next few years. So one is the poverty reduction. Secondly is the environmental protection. The third one is financial risk, to control financial risk. So in that sense, all the Chinese, either the financial institutions or agency, the military, etc., they pay a lot of attention to help on the poverty reduction. In that sense, you talk a lot about the inclusive finance, for example. So this topic has been quite, popular in China. Everybody talking about this. I'm sure in this sense, European country, for example, I'm sure you have lots of experience in that to help China, and China working hard on that. I think that also explains the reason why China over past few years, etc. So many called rural banks, they have been established in China. And I'm not saying the good or bad, probably too many, right? Probably too many rural banks have been established in China because some of them, they don't care about profitability. Eventually, we'll have some financial risks, but that's not, I'm going to talk about the focus of what I'm talking about. That's mean Chinese government, including central and local government, and also many financial institutions are working on that. So probably they want to try to do some tests to see how it works, how to help to reduce poverty reduction, etc. Because President Xi already set targets to eliminate, the poverty people by 2020, only 2 years. We still have, I think, 20 or 30 million population now, so it's very hard, but the target is over there. Last one is one Belt One Road initiative. So from my understanding, I think, of course, there was competition between Chinese financial institutions and foreign financial institutions. I think that's a healthy competition, Because when we go to a third market, for example, in Latin America or from African country, for example, or even go to the Eastern Europe, I'm sure, Chinese bank, we need local partner. Because we don't culture, we don't speak language, we don't have branch, etc. So in that sense, I'm sure, Chinese financial institutions or banks, they have sincere, willingness to collaborate with local partner. So in order to jointly develop, it's a win-win situation. One Belt One Road initiative. So that is not only zero games. Zero-sum game. So I think everybody can benefit from that, as long as we can find good way to collaborate with each other. So I'm quite optimistic about this.
Thank you. I'm glad that you mentioned Latin America, competition in Latin America, because Alicia is about to publish another piece on China's competition with European companies in Latin America. But Elena, you have the last word, please.
Well, I think that we are much over the time, but there are so many important points that were made. I will just pick up some of, give some thoughts. On the question about export-led versus domestic demand and the role of the financial sector, I would just say that I don't think that because it's export, it's necessarily more competitive or more productive, because the whole role of the subsidies policy in some of these export sectors has been very important and is still very important. So I don't see a one-to-one that you move from export to domestic, you become less productive. It depends. And then I would say on the financing of the growth model, again, to me, it's not so much about who is the owner or what is the policy, but it's more about what are the criteria that are driven the decision. So if the financial sector is told, let's say, to invest in high-tech, whatever, which will increase productivity and so on, maybe it's a positive step. If it is told to do something else or to invest in other sectors that are not going to bring about a high productivity growth, then it will not be good. So the same kind of policy decision making can lead to very different results. On the on this using the financial sector, again, I mean, I think that if it is really used like a sort of a substitute for fiscal policy, then I think it's not good. If it is used to facilitate or to promote investment on forward-looking sectors, which may also have a demand component, but that's not the objective, then we can have better results. So on the international, etc., I would say that, okay, we had this experience. I cannot say much about this trade and investment because I'm not really inside, so I would not be probably fully up to date. What I sense is that it's not becoming easier lately, these kind of conversations. Maybe whatever may happen with the US may change that as well in terms of the bilateral relations between China and Europe. So I have some hopes that that could help. But it is true that the experience we had with the tiny thing that it was, you know, when we launched the investment plan and then high interest from China to be involved, etc. But after all, everything became quite limited in the sense that when the specificities for China companies and specificities to be respected for China investment and so on, in Europe we don't have these rules, we have other rules and we cannot accommodate that because we should do it for others as well. So it doesn't really fit with our competition system and etc. So then it was much less enthusiasm. So that's just to show that it is difficult. But I think that we cannot escape from that discussion about trade investment or trade and investment or maybe investment and then trade, depending what. So we have this possibility also to disentangle a little bit the trade and the investment negotiations currently in Europe. So we have to see what is more promising. And on the lending outside and the Paris Club and all this, I was not thinking about Venezuela. I was thinking about one of the African countries where it's more than just China, Russia. It's not necessarily Russia, but it's a little bit more diverse, but main China. And there is an attempt here with the help of the Paris Club to get to some good results. So that might be a showcase. Let's see how it works out, but it could be a positive step to see that cooperation at the international level can bring a better result, including for China. And I would say that another aspect is about the lending conditions. I mean, I have some insights on some of these investments in Latin America or in other countries in Africa. Indeed, I mean, there is a lot of lending with no conditions, piling up debt in those countries or in the corporate sector of those countries. And when the problem comes, somebody has to do something, either an IMF program or an international rescue package or whatever. So there is an issue here that needs to be addressed. It cannot, it has implications for the country, but also for the stability of the system. And final point, I think that all these things you mentioned about investment in Pakistan for the China, etc., I think that geopolitical matters that we didn't have the time to discuss are very, very important. Iran, India, I would mention in this context.
Sure. I think that's scope for another event. So please join me in thanking our panelists, and my apologies for running over time. It's entirely my fault. So thank you to all the panelists.